Welcome to the Canadian Investors course, Session 3, Introduction to Equities. Each of the previous slide packages, please review page 2, Terms of Use and Disclaimer. Session 3, Introduction to Equities. We're going to look at capital markets, stock market and some commodities, REITs, and income units. See Wile E. Coyote jumping off, he's part the way off the cliff with his help sign. Was this you in March 2009? If so, listen on. And even if not, you might want to listen on. So let's do a quick bond market review. Some questions. Where are interest rates today in relation to history? Can I still make money in the bond market? And what are risks to my capital if I own bond funds or balanced funds? Those are important questions to ask. Well, remember from our income investing slides, this is an even longer chart. This is page 6. If you look back in the early 20s, interest rates were 4 or 5%. They got down as low as 2%. In 1982, they went up to 16 or 18%. And then today, now they're at the lowest rates in history, well below inflation, well below 1%. It's extraordinary and likely unique. So, looking at our introduction to equities again, we're looking at capital markets, stock market, and some commodities, REITs, and income units. Let's take XYZ Corporation and show you how a company evolves. So the evolution of XYZ Corporation using capital markets. How does a company go public or become a publicly traded company? Well, if we take XYZ company and the bank, let's follow the story. It started as a Mississauga tool and die company in 1965. The owner was John, and it was the owner and 2 employees, John Doe and his 2 employees. 3,000 square foot industrial unit. Source of capital was John's savings and a little bit of money from the bank. And John borrows for equipment and a mortgage on the unit. Next, let's look at it in 1970. It's grown to a staff of 40. John sells the unit at a profit, buys a 10,000 square foot building and equipment. The bank provides all the debt requirements. They've known him now for a while. In 1975, 3 major customers are taken on. John buys the 15,000 square foot building next door. Staff grows to 250 people. Let's look at it now in 1980. They've required a huge long-term contract. Both buildings are sold. A 200,000 square foot factory space is acquired, plus new equipment. They've got 600 employees running on 3 shifts. Building and equipment are financed by the bank and sales plan to exceed $100 million a year. The company's on a roll. 1985, XYZ Corporation raises capital for short-term needs using a banker's acceptance. In other words, the bank guarantees their debt. They put the debt out. The debt is marketed according to what we described in the income segment, session 1. $5 to $10 million of BAs roll every 60 to 90 days. In 1990, XYZ Corporation is approached to merge. So they merge with TV Corporation and they form Tool Corp. So now what happens? 1991, Tool Corp has magnificent expansion plans. They're going to expand across Canada. They require lots of capital. Sales are now over 500 million and they've got 1,000 employees. So the bank introduces Tool Corp to the corporate finance arm of their investment dealer. In 1992, Tool Corp goes public through an IPO. That's an initial public offering. 40% of the company sold to the public. Total shares outstanding equal $1 billion market capitalization, and the shares trade at $10 a share on the TSX. Ticker's TC for Tool Corp. The nice thing is 40% of the stock was sold to the public, 60% is still owned by the owners, and now they've got a market price based on the fact that it's publicly traded, and they've got a lot of their money off the table. So how does Tool Corp do this IPO? Investors buy shares sold through the investment dealer. Investments like the company and feel they can grow their money. Incorporation occurs. The company is now public, has many new owners, has shareholder meetings, public disclosures, Securities Commission, accounting rules. But the good news is there's ease of transfer of ownership. The new owners can participate in dividends if any are paid. Shareholders get to vote for or against management. There are quarterly and annual reports. And of course, insider rules apply. The company gets money to expand. And there's less liability for the stakeholders and no new debt. So far, so good. 1993. TC now has 2 factories and is about to open a 3rd factory. They issue $150 million in convertible debentures. They're trading for $17 a share. Convertible debentures have a 2001 maturity date, yield 5% interest to investors, and they convert at a $20 conversion price. So in other words, the shares are trading at 17, but if they get over $20, they trade as if they were start to trade as if they were the stock more than if it did debentures. Very attractive for the unit holders. The debenture holder has the option of converting if the shares trade over $20. And that's why they start to trade more like the stock than like a bond. And they have a BBB rating, so they're investment grade. Good quality. Now, why do they sell $150 million in convertible debentures? Well, investors need income and like potential growth down the road. Tool Corporation gets to expand. Interest payments on convertible debentures are lower than straight debentures or a bank loan, so it's cheaper for the company to do it. And a convertible debenture is subordinated to other debt, so it doesn't interfere with with their debt structure, so there's less liability for Tool Corp. It's a good deal for everybody, especially since the conversion's at a reasonable level. In 2000, Tool Corp gets taken over at $30 a share. New.com wants to diversify and overpays for Tool Corp. John Doe retires rich. The employees form a union. Debenture holders can convert to shares or sell the debentures for $150, originally bought for $100, so they're happy. However, in 2000, New.com goes bust. Bank sells Tool Corp division to Cheap Tool and Die. Cheap closes factories, lays off workers, and moves everything to China. So that's sort of the life and death of a company. Let's look at stocks and bonds continued a little bit more. Once a new issue reaches its settlement date, it begins to trade, and investors have liquidity through various listed exchanges. For example, the TSX. Stocks and debentures trade on the TSX from 9:30 in the morning to 4 in the afternoon on days the exchange is open. Each instrument has a bid price and an ask price. An investor can place a market or a limit order. Orders can be left open for a number of days, and the size of order and the typical amount of shares traded daily are very important because that constitutes the liquidity for the stock. The main positives of stock ownership are liquidity through stock market activity. Shareholders participate in the profits through dividends. Shares may appreciate in value, generating capital gains. There are public regulators that supervise the function of the company, and there has to be public disclosure of all the activities of the company. Now, let's look at some limited liability examples. Going back to Tool Corp. In 2000, Tool Corp was taken over by Newco at $30 a share, or half a share of New.com shares. So sellers for cash must pay capital gains. Convertible debenture holders can sell debentures and receive the shares or cash equivalent at $30. each share originally bought for $100 can be converted, and it was very attractive to do so. The capital gain deferred for investors who choose to convert their TC shares to new.com corporate shares also exists. So if they feel that the future investment is a good investment, they can roll the old shares into the new shares without triggering a deemed disposition. In 2002, new.com goes bust. The common stock investors lose their investment. The liquidation of assets occurs. Bank loans are at the front of the line. Common shares holders are at the end of the line. Now, let's look at stock market and stock market indices. The majority of stocks in Canada trade on the TSX or the TSX Venture Exchange. There are 3,278 individual Canadian companies listed on the TSX and TSXV. There are also 245 international companies listed. Investors look at the index, which is reported each day. The index is made up of a portion of stocks from the exchange, typically the largest capitalization ones. Main Canadian indices are the TSX Capped Index, the TSX Capped 60 Capped Index, and the S&P TSX Venture Index. So let's break down the Capped Index. In Canada, the S&P Capped Composite Index, which is maintained by Standard & Poor's, restricts the weighting of any component to a maximum of 10%, regardless of market capitalization. The idea is that if you got a Nortel that becomes 30% of the exchange, only 10% of the portfolio would consist of Nortel. The S&P TSX Capped Composite Index was introduced in 2002, and it was subsequent to the rise and fall of Nortel, which at its peak accounted for almost a third of the total market capitalization of all stocks on the former TSX 300 index. Commodities. List of various commodities listed on exchange in the form of future contracts. So there's corn, oats, rice, soybeans, canola, wheat, milk, sugar, cocoa, coffee, cotton, frozen orange juice, hogs, cattle, crude oil, ethanol, natural gas, heating oil, gasoline, and so on and so on. The commodity exchanges, for example, the CME's Chicago Mercantile Exchange, handle these commodities. Let's look at real estate investment trusts, or REITs. Real estate, it's a way of owning real estate indirectly. You own a portfolio of properties, you get professional management, you get monthly or quarterly dividends, typically some geographic diversification, and if not, you can create geographic diversification by owning more than one. Usually, they're no more than 50% mortgaged. They have different categories. So, for example, there are commercial REITs and residential REITs and apartment REITs and so on. Depreciation of assets is passed on to the unit holders. They produce fairly high income with liquidity. So it's a nice, easy way to own real estate without some of the headaches. A couple of REIT examples are RioCan REIT, which owns regional shopping centers, tickers REI.UN. As of August 2016, the price was $28.86, had a forward price earnings ratio of 19.4 times, and a dividend yield of 4.86%. Nice, healthy income. Then there was Northwest Healthcare Properties, which at $10.20 in August 2016 had a forward price earnings ratio of 19.6 times, again, but a dividend yield of 7.84%. These are just two examples. Let's look also at closed-end units. That's a set portfolio selling as a unit or share. The investment parameters, which are the investment criteria that are set, define how the investment's going to be operating. They have professional management. They're an alternative to mutual fund, typically have lower management fees. They pay dividends. They have a net asset value. They usually trade at a discount, and the idea is that they should have plenty of liquidity. couple of examples are the PIMCO Global Income Opportunities Fund and the Goldman Sachs U.S. Income Builder Trust. The thing is that sometimes these things trade at a substantial discount to the net asset value. Now let's look at a commodity example. The Global Agriculture Index ETF, ticker COW, dividend yield 1.83%. The price equals the NAV, because it's an ETF, is $30.31 in August 2016. They own a collection of agriculture stocks, mostly in the U.S. Very tiny MER, 0.62%. Now let's look at some structured notes. There are principal protected notes, PPNs, and principal at risk notes, where the principal is not guaranteed. Remember, nothing's free. If you've got principal protection, you're paying for it. The idea is that you're exposed to equities with minimal risk. They provide a principal guarantee. You're exposed to the upside of the equity markets, but usually the upside exposure is capped. They're available through investment dealers, and sometimes they show up as index-linked GICs at the banks. Those are forms of principal protected notes. Principal at risk notes are not guaranteed, and therefore typically they have specific terms. Let's look at PPNs in more details. The fees on PPNs and on index-linked GICs are hidden, and they're large. PPNs offer liquidity, typically after 2 or 3 years, because that way, by that time, the fees which could be 3 to 6%, are amortized. PPNs tend to be a little more fair and have even less fees than index-linked GICs. If you're looking for a principal guarantee, PPNs tend to be a little bit better investment than index-linked GICs. But index-linked GICs are readily available through many of the banks, through the bank branches, and in very small quantities. The moral of the story is ask what the total fees are. But in all cases, you're paying for the guarantees, and these are not very efficient investments. If you want to know more about it, it's worthwhile reading slide 32 because it goes into a little more detail on the on an actual 3-year index-linked GIC, showing the details of the formula. Let's look at principal at risk notes now. Typically, the idea here is they limit the downside, but they don't eliminate it. Most are options based, so they're much lower in cost. They typically run 1 to 3 years in duration. You have to hold them for a year. After that, they're open for resale. Some of them have 1-for-1 downside. Some have 3-for-1 downside, with a maximum 27.5 maximum downside potential. After that time, you have full market risk. So the idea is that it protects you for the first 27.5% of a market correction. A small return in the market delivers a respectable return for the investor, however. Most of these notes have liquidity. You can sell them on any given business day and take advantage of a move. Now, you have to remember that these things have a 1 to 3 year duration, and it's rare for the stock market to move continuously up for 3 years in a row. So that liquidity is quite important. And that is the end of this equity slide deck.